Sasol has slashed the budget for its greenhouse gas emission reduction roadmap by 70%. That's according to CEO Simon Baloyi, who was speaking at the group's 2025 Capital Markets Day. The firm will now spend no more than 7 billion rand on the initiative, but says the move will not affect its targets. The group believes it will still be able to reduce its global greenhouse gas emission footprint by 30% come 2030. The decision forms part of Sasol's turnaround strategy. Further to that, the company has stated that it will make it an immediate priority to restore the performance at its Lake Charles business so that the unit can achieve earnings before interest, tax, depreciation and amortization of $1 billion. This will allow Sasol to explore the option of listing the chemicals unit or other potential strategic transactions. The group has also announced that it expects to resume paying dividends in the next 2 years. That's as it's changed its payout policy. The dividend will now be triggered once net debt is sustainably below $3 billion. Previously, the level was set at $4 billion. Sasol says this allows the business to maintain a resilient balance sheet and ensure a sustainable future for shareholder returns. Nutun's narrowed its losses in the first half after restructuring its business by selling non-core assets. The group formerly known as Transaction Capital has posted a loss from continuing operations of 71 million rand. That's from 104 million rand previously. Nutun says while a lot has been achieved in the first year of the 2-year restructuring process, the transition will need time to become embedded and gain traction in the business. The company suspended dividends until the restructuring has been completed. AlexForbes is eyeing higher year-end profit. The financial services group expects its headline earnings per share to increase by up to 20%. AlexForbes says its operating financial results are in line with expectations and that the performance reflects continued growth in operating income due to strong market growth. It's also pointed to inflationary increases within its retirements and healthcare consulting client base, as well as high client retention. Stephanui is confident that it will be back in the black when it publishes its annual results. The construction firm expects headline earnings per share from continuing operations to be as much as 125.5 cents. That's from a loss of 5.5 cents previously. The market has reacted positively to the announcement, sending the shares up 15.15% today. Stephanui will open its books on the 27th of May. EPE Capital Partners has reported a rise in quarterly net asset value per share. The investment holding company says that metric sat at 8.10 rand at the end of March, and that represents an increase of over 3% when compared to December last year. And that rise is largely due to revaluation gains on fast-growing fintech business, Optasia. Further afield, China cut benchmark lending rates for the first time since October, while major state banks lowered deposit rates as authorities work to ease monetary policy to help buffer the economy from the impact of the Sino-US trade war. Let's take a look for more detail.
Trade war fears are hanging over China's economy, and Tuesday saw Beijing policymakers play their latest hand in response. The country's central bank cut its benchmark one-year loan prime rate by 0.1 of a percentage point to 3%. Its 5-year rate, key to setting mortgage prices, fell by the same amount. Earlier in the day, several of the country's top commercial banks also cut their deposit interest rates. That was seen as guiding smaller lenders to make similar reductions. One economist told Reuters that all the rate cuts are meant to boost lending and stimulate consumption. The moves are part of a package of measures announced before China and the US agreed a truce on tariffs at talks in Geneva. That deal spurred analysts to raise their forecasts for Chinese growth this year, but huge uncertainty remains. Nomura chief China economist Ting Lu said it would still be quite challenging for Beijing to hit its 5% growth target for the year. unless policymakers step in with more stimulus and reforms. Figures out earlier in the week showed new bank loans tumbling and home prices staying flat, pointing again to areas of weakness in China's economy.
And Nippon Steel plans to pump $14 billion into U.S. steel, with up to $4 billion going toward building a new steel mill pending approval of its acquisition bid from the Trump administration. Here's more detail in this report.
Nippon Steel reportedly plans to invest $14 billion in U.S. Steel's operations. The investment would include up to $4 billion in a new steel mill if the Trump administration greenlights its bid for the U.S. company. That's according to a document and 3 people familiar with the matter. Under details of the plan included in the document, the company will plough $11 billion into U.S. Steel's infrastructure over the next 3 years, including $1 billion in a greenfield site, which is expected to grow by $3 billion over the following years and has not been previously reported. Shares of U.S. Steel rose and closed up more than 3% after the Reuters report. The investment pledge is pitched as part of a last-ditch effort to win approval of the merger. It's previously drawn fire from both Presidents Donald Trump and Joe Biden. The companies face a May the 21st deadline for the completion of a fresh national security review of their proposed tie-up. Trump would then have 15 days to decide the fate of the transaction, although the timeline could slip.